Hello, and welcome to Fidelity Connects. I'm Lauren Gardy. Today's guest is here to unpack the market forces driving investor decisions so far through 2025, with a focus on how quantitative insights can help us navigate what's ahead. From tariffs and rate cuts to factor leadership and the influence of AI, we'll explore how these themes are shaping both North American and international equity markets. We'll also examine where investors are finding opportunities, whether in momentum, value, or high quality. I am very pleased to be joined in studio by Bobby Barnes, Fidelity Head of Quantitative Index Solutions, who will help us put these trends into context for our listeners. So welcome, Bobby. It's great to have you in our Toronto studio today.
Yes, I'm thrilled to be here. It's the first time.
Yeah, excellent. So last time you were on Fidelity Connects back in June, tariffs were a really big topic of our conversation, and this has continued over the past quarter. Curious if you can start us off today by unpacking for our listeners how tariffs are impacting current market conditions and factors.
Yeah, so it's been quite a roller coaster ride with respect to tariffs this year. Still very important where we are now. And what's very interesting is I've observed three very distinct phases of factor in market performance over the course of the year. And so at the beginning of the year, you kind of had a continuation of the trend, of the prior trend, which was kind of led by the Mag 7. From a factor perspective, quality and momentum were outperforming. And so that was kind of phase one, lasted up until about the middle of February. Then from February to the early April, you had what I call the tariff tantrum. And that's when there was a lot of uncertainty and there was a bit of sticker shock when the tariffs were first announced on Liberation Day. And what was very, very interesting from a market perspective, not only was the market down a lot, but from a factor, you had a massive factor rotation where what had been working, quality and momentum, those were the worst performing factors. And then basically everything that had not worked, whether we're talking about value or small size or international, all of that did extremely well. But then off of the April 8th low, that's kind of your phase three, and it's continued on through Q3 of this year, where you've had a little bit of a resumption of trend with the one caveat, and this is a bit more recent. So momentum's still the kind of the dominating factor, but you're also seeing high beta outperforming, and that's expressing itself, especially most recently, in things like small caps.
Mm-hmm. That's great. And so right around the corner, we have earnings season.
Yes.
I'm curious if you're expecting generally positive news, or do you think investors might be in for any surprises?
So what's interesting there is I guess to first answer your question just very succinctly, I am expecting positive news. And what I'm seeing that makes me think that is when I look at throughout the quarter earnings revisions, a very interesting thing has happened, and it's actually rare. And so what's happened is for the U.S. market, earnings have been revised higher. And what's rare about that is that it almost never happens. Like, as investment professionals, we all tend to be overly optimistic. And so when you look at our forecasts at the beginning of the year, they're usually too high. And then, so the natural progression of revisions is typically down. And so because we were in a rare environment where you're seeing positive revisions, company reports are going to start rolling out, and I think you're going to start seeing some surprises as a result of that. Where basically, I think what's going to happen is the tariffs hasn't been as bad as what people thought, and so you're seeing the positive revision. I think is a unwind of that, and so I think that we'll see that play out as companies continue to report. But the most important question to answer is how long is that going to persist? Is it just an unwind of an overly, downside pessimistic view of tariffs, or is it going to be actually persistent into 2026? And this kind of brings into the conversation, fiscal policy, the big beautiful bill. Is that going to be stimulative in a way that drives more forward upside surprises?
Mm-hmm. That's very fascinating. Can you talk to us from your quantitative lens, where you believe we are in the current market cycle?
Yeah. So with where we are in the cycle, I've been saying this all along. I think we're in late cycle. There are a couple of ways that I get there. Some of your viewers might have heard me talk about what we call our deja vu model, which essentially looks at macro variables where they are today, things like oil, ISM, unemployment, so on and so forth. And just looking at those levels, it kind of creates a fingerprint that we can then compare to other points in time to see what are the points that are most similar. When you do that, and then kind of just say pick the top 10, almost uniformly, all of them are late cycle. But even if you take that aside, if you just look at the characteristics of the current market environment, like we're kind of at full employment. Unemployment bottomed at 2.4% in I think 2022, 2023-ish. That's a very low level of unemployment, and so it's if you think about the cycles, like okay, that's too low to be early cycle because early cycle you've got your unemployment very high and falling. It's also with mid cycle, it's also not mid cycle because that's characterized by unemployment that's also continuing to fall as additional people find jobs. And so if you kind of take that simplistic view at answering where we are in a cycle, you arrive at the same or similar place as what I said from our deja vu model, which is okay, your unemployment has bottomed. We're still experiencing positive growth, but at a slowing rate, so therefore late cycle.
I like the branding you put there. So let's talk about interest rates. We've seen interest rate cuts and sounds like we're expecting more. But can you tell us from a factor perspective, are certain factors more sensitive to interest rate movements than others?
Yeah. So in the work that I've done there, the obvious one is dividends. And high dividend paying stocks, and in a lot of ways, they trade similar to a bond. And so you think about just bond math, when interest rates go up, bonds are worth less. And then vice versa, when interest rates fall, the coupons you get from a bond are more valuable, and hence the bond itself is more valuable. And so high dividend paying stocks perform very similarly. And if you run the correlation, you'll see that they move directionally the same way that a bond will as interest rates rise or fall. The other factors, not as much sensitivity. When you look at things like value, quality, momentum, they're not as sensitive. I guess and then small size also not very sensitive. You do see some of that characteristic exhibit itself with low volatility. Not as much as you see it with dividend, but low vol does have kind of a bond-like characteristic to it. And so to the extent that interest rates fall or continue to, it can be a tailwind to high dividend and low volatility.
That's helpful for our investors listening. Thank you, Bobby. Let's bring FX into the conversation while we're on interest rates. How should investors be thinking about FX movements when it comes to factor investing and investing geographically as well?
So FX is interesting, and my unsatisfactory answer to you is that it's really hard, and I don't think you should do it. At least in terms of trying to forecast where currencies are headed. A lot of very smart people try to do it and do it unsuccessfully. But I do think it's very important to, when you look back over the course of this year, to understand how FX has played into the market dynamics and kind of think about, okay, from where we are today, do I think that those dynamics will be persistent? And so the important thing about FX is that I think it's very well known that developed international stocks have substantially outperformed North American stocks year to date. Just to put round numbers on it, developed international, I think, is about 25% cumulatively at the end of Q3. The S&P 500 is, call it 15. So it's 1,000 basis points outperformance. And that's been driving a lot of investor interest as a result of that. But if you unpack, okay, well, how much of that was due to actual fundamentals being better in the international space as opposed to just the currency, a lot of it was actually the currency. And so if you recompute international's performance year to date and strip out the currency effect, you actually end up with returns that look very similar to the S&P. And then on top of that, the other consideration that you always have to make when comparing the S&P to other regions is the mix shift. So the U.S. market is a very tech-heavy market. It's about 30% of the U.S. portfolio. That's what you're implicitly getting. When you pivot to developed international, you end up betting much more heavily on financials. And so then your calculus then is, okay, do I think international financials are going to outperform U.S. tech? And so when you control for that, for the currency and the mix shift, the composition of the sectors being different, then you find out that the developed international stocks have actually underperformed the U.S. stocks. And so I think those are the key things that people should think about, when looking ahead. Okay, if I'm running a global portfolio from this point forward, do I want to overweight developed international versus U.S.?
That's a very interesting perspective. Thank you for sharing. Focusing on the US, I mean, we have seen such a polarization in policy so far this year. What should we be thinking there, and how much of that uncertainty is priced in?
So zero is priced in, and the way I arrive at that conclusion is just if you look at valuation multiples, stocks are at a very large premium. I think on a trailing basis, I think the S&P last time I looked was maybe as high as 28 x on a trailing PE basis, and then even on a forward basis, it's not much better, maybe 25, which from a historical lens is very high. And so that basically says that we aren't discounting risks if we're willing to pay that much of a premium or that much of a multiple on future expected earnings. Same thing in bonds. When you look at credit spreads, they're very tight. And so when they're very tight, that's the investors implicitly saying, I'm not really that worried about any of these uncertainty, and hence I'm willing to pay a large amount of money for these bond coupons. I'm not saying that any of those assessments are right, but it just is what it is. That having been said, it's very instructive to listen to what company management is saying. And there's very much still a lot of uncertainty out there. And if you listen to company management, a lot of them are saying, look, listen, our customers don't know what to do. Our orders are down because we don't know what the tariff tax is going to be on the order, or in terms of capital investment, I don't have the comfort or the clarity to make a $100 million investment in a new plant because I don't know what it's going to cost me in order to get the materials back and forth. And so I think that as looking where we are today and looking going forward, that's still an outstanding risk. And it's probably worthwhile to have that discounted either in the valuation multiple or the credit spreads.
For sure. So on a positive note, in the US, of course, we've seen AI drive so much of the market growth within that space. Can you talk to us about how AI is impacting factors?
Yes. So I've been doing a lot of work on AI, and I've got a lot to say there. It's from a factor perspective, it's been driving the outperformance. So if you take the performance of the various factors, value, quality, momentum, low vol, small size, high dividend, and just sort them by performance, what you will find, and I said this earlier, that momentum is kind of at the top. It's the leading performer year to date. What you'll find is that if you sort them by performance, you'll get a certain stack ranking. If you conversely sort them by their exposure to AI, like how much does this factor portfolio have invested in AI, you get a very similar ranking to the performance ranking. And what that means is that AI is driving the performance of factors. And so I think that's important to know, because you have to decide, okay, if someone says, hey, Bobby, I want to invest in small caps. What you don't necessarily know, but the implicit bet that you're making is that small caps actually has the least exposure to AI. And so that's actually a bet against an AI. And so if that's the bet you want to make, that's fine. But I would probably guess that a lot of investors don't realize that with these factors, these various factors, they could be making a bet for or against AI unknowingly.
Very interesting. So within your team at Fidelity, has AI influenced your process at all, or enhanced how you work or do things?
It absolutely has. The first thing I'll say is that it's very important to us, however, that we keep a human in the loop. So AI isn't making any investment decisions. We're using it as a tool to inform our decisions, but there's nowhere at Fidelity is there investor assets that are purely being invested based off of AI. So that having been said, my little disclaimer, what it looks like internally is from a fundamental perspective, we're enabling our fundamental analysts to do their job faster. So if you think about earnings call transcripts and summarizing what's said from company management on those earnings calls, pulling out the relevant data, tables, et cetera, we're using AI in that respect. Within the quant team that I manage, we're using AI. Quant is a discipline that requires coding, for example, and so my direct reports have access to AI tools that you literally can prompt the AI and it'll write a snippet of code for you, or a long piece of code for you that would have taken you maybe an hour to write yourself. you're getting that done in seconds, right? And so here again, similar to my fundamental counterparts, that's really an expression of productivity enhancement. And so that's what AI looks like today within the investment landscape at Fidelity.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Very fascinating, thank you. Outside of Fidelity, have you seen proof of AI productivity advancements, especially thinking against the backdrop of a changing labor force?
I've heard a lot of anecdotal evidence. I shared what my team is doing. I have a background where, a lot of my friends, went on to get PhDs, and so they're now professors at various universities. And, when I talk with them about their workflow, it's very similar, where they're, using AI to summarize or, effectively read through, hundreds of research reports and come up with a summary. And so you're definitely seeing that productivity enhancement, but you also use the word, workforce and any impacts there. That I'm not necessarily seeing. I'm not hearing people say, hey, because I use this AI, I'm not hiring the one incremental person that I would have hired otherwise. That's something that I think a lot of people are worried about. And I do get this question, particularly from students who are aspiring, investment professionals. But I'm not yet seeing that concretely in decision makers' decision making.
So our jobs are safe for now.
For now.
Fantastic.
Right.
Well, I'll pause there for a minute and encourage our listeners, if you do have any questions, please bring them forward and I will bring them to Bobby as well. But in the meantime, let's pivot to factor performance so far this year, Bobby. We've seen value, high quality, momentum, all interchangeably lead the charge so far this year. Could you walk us through what we've seen with this performance year to date and which factors you're favoring currently?
Yeah, so as I mentioned, kind of at the top, we've kind of round tripped. We had the three different phases, the continuation of the prior trend led by quality and momentum. Momentum number one, and then quality was second. The tariff tantrum, was kind of an episodic reversal of that trend that has subsequently subsided, and so now we're back to the continuation of that trend, led principally by momentum, and so that is the best performing factor year to date. Quality is, ever since the bottom of the tariff tantrum, quality has not participated as much, but a lot of that has just been because of the outperformers of the high beta that I mentioned earlier, which, again, the question as an investment professional you're always asking is the trend that I'm seeing right now going to be persistent? I would submit that I don't see that being persistent with high beta continuing to outperform. I think it's going to end up being episodic, and then we'll get to a different place where quality will resume its outperformance, much similar to what it did earlier in the year. And so that's, from a factor perspective, those will be my top two: momentum and then quality.
Very helpful. So actually, it's great that you mentioned those two. I wanted to ask you if there's anything that Fidelity does to differentiate ourselves from the industry in terms of how we develop those factors. Maybe you can walk us through quality and talk to that. Sure,
yeah. So one of the tenets at Fidelity, if you ever listening to someone like me or anyone else in investment professional Fidelity, we say that stocks follow earnings. It permeates how we think about the markets and how we design any portfolio, whether it's a quant factor portfolio, which is my area especially expertise, or a fundamental portfolio. And so in looking at, with that mantra in mind, so you mentioned quality, we are very differentiated in how we define our factors. It's kind of twofold. One is how we do our stock selection. And so for quality, we define quality using the best ideas from both our fundamental analysts and our quantitative analysts. And so with that mantra that stocks follow earnings, our quality definition is using things like free cash flows, margin, and free cash flow stability as being key features for that definition. Similarly, on momentum, same thing. I mean, we believe that stocks follow earnings. And so to the extent that you want to have a high momentum portfolio that's going to continue to exhibit those qualities, We look at things like earnings surprise as part of our definition for defining a momentum stock. And so those are key differentiators across our entire factor suite that help us do a better job at stock selection than our competitors. The other big one, which is a little bit more subtle, is in our portfolio construction. Because we, as an active manager, we're always thinking very deeply about what bets are we making, both implicit and explicit. That was kind of some of my commentary today about, okay, well, here's some other bets you might not realize you're making in a portfolio. And so we take a very thoughtful portfolio construction approach such that we're trying to drive consistency of return over time when we've constructed the portfolio in a way that mitigates any unintended bets that the shareholder might not be looking to have.
Mm-hmm. That sounds like a great advantage that Fidelity is providing to our investors, so thank you for that. We've had a question come in from the audience asking about gold and your thoughts on it as a sector or area of the market.
So gold is very interesting, and I probably have a very provocative, although not unique, thought on gold. Okay. So it's a lot of people, asset allocators, talk about it as a diversifier. I don't disagree. You can run those correlations yourself and see that. But where I struggle with gold is I don't know what it's worth. It's sitting at, call it $4,000 an ounce today. And if you said, Bobby, sitting at 4,000 today, it cuts in half to 2,000. What do you do? Well, I don't have an earnings outlook for gold. Same thing on the other side. What if it doubles? It's sitting at 4 today and it goes to 8. Okay, what do you do? Similarly, I can't tell you to sell it because I also don't know whether or not what their earnings. I mean, it doesn't have an earnings outlook, and so for that reason, people of a similar mindset. So Warren Buffett, is one who thinks the way I do about it. He calls it an unproductive asset, and so sure, it's got these diversifying attributes, but I struggle with knowing how to react to it and when, which is a problem I don't have if you're asking me this question about stocks, and I can look at the earnings outlook and the valuation multiple and can triangulate to what I think an investor should do with it.
Mm-hmm. That makes a lot of sense when you say it that way. So I wanted to go back to small caps for a minute. You phrased it earlier as possibly being a bet against AI. We don't have a small cap factor ETF, but curious your thoughts on this space.
Yeah, so it's small caps like all factors have their own time in the sun, right? There's a time that is very fertile and a tailwind for that asset class. There is a bit of a debate on its attractiveness right now, and I'm going to explain both sides. And so there's one argument that's being made that based off of the current fiscal policy, tax policy, rate policy, that these things are going to be a tailwind for economic activity, and therefore a tailwind for small caps as a beneficiary from the increased economic activity and the lower cost, because a lot of their the debt held by small companies, it's variable debt. So if you take the short end rates from the Fed and lower that, all things being equal, that lowers the interest cost and burden of a small cap company. So that's the argument. That's the framing. As you can probably see, I'm not necessarily in agreement with that because I think that there are parts of that framing that are a bit in a vacuum. And so yes, that's true that interest rates going down in a vacuum. If you don't change anything else, then that should be a tailwind to small caps. But the problem is we don't live in a vacuum. And so you need to ask, well, why are interest rates going down? If they're going down because there's concern about economic activity slowing, which I think there's at least a reasonable argument to be made for that, then that kind of offsets some of that tailwind. And then you kind of arrive at a place where you're not as constructive on small caps. And that's kind of where I am in my framing and my thinking, based off of where we are in an economic cycle, late growth, which is characterized by a growing economy, but growing at a slower rate. And, with the rate policy being, the forward outlook being more cuts, but some of that due to concerns about labor market weakness. A weak labor market is not, it's not illustrative of an environment where you've got increasing economic activity. Right, those things don't go together. And so, with respect to small cap, when I weigh those things plus the implicit bet you're making against AI, as I mentioned before, that I'm probably in terms of my rank order of factors, I'm least constructive on small cap. But again, there's a bull bear. That's what makes the market, right? But that's where I fall in thinking about where investors should allocate.
Mm-hmm. It's a good perspective to be thinking of it from a wide variety of different influences, not just the one of interest rates, as you said, which maybe we do most commonly. So you touched on international earlier in our conversation. I wanted to spend a little bit more time here since we've seen tremendous flows in the industry into international ETFs this year. And interestingly enough, in Canada, it's the first time that Quantitative is outselling passive in the international and global space so far. So curious to hear a little bit of a deeper dive on factors within the international space.
Yeah, so it's a very interesting dynamic. I explained why I think, at least from an allocator's perspective, I'm not as bullish on underweighting, say, North America to allocate to international. But a lot of people do run global portfolios, so you're going to have some allocation. And the interesting thing that I'm saying with respect to international, amongst the allocation that you plan on having there, is from a factor perspective, value is doing extremely well internationally. And then part of the reason why it's doing well is especially our Canadian value factor ETF, on its way to exposing the shareholders to cheap stocks, it's overweighting financials. And again, back to the mantra of stocks follow earnings. And that's why I focus so much on my mental calories on earnings and where they're headed, where the revisions are happening. In the international market, European financials are having the best earnings revisions year to date that we've seen in a long time, and far better than the other sectors. And so to the extent that you've got a factor portfolio that's overweighting European financials, which our value factor does, that's been a tremendous tailwind year to date. And I actually get to my second thing that I always harp on about persistence. Is it going to be persistent from here moving forward? I think that I think there's a good likelihood that it will, partly driven by the fact that the European, with all the global turmoil we're having, what's come out of that is that a lot of these European countries are going to need to finance their own defense. And that's going to be very great for the capital providers who do that, which fall in the financial sector. And so within your developed international allocation, my favorite would be a value factor portfolio. And then from there, followed by momentum, because here again, based off of where we are in the cycle, I think that momentum is do a better job of capturing those stocks that have the secular growth in that region. Mm-hmm.
So it sounds, if you were to say provide constructive advice for someone who might be looking to diversify away from U.S. large cap, you would favor an international value or momentum over small cap.
Yes. I think the best diversification versus top heavy U.S. market would be European value would be my number one favorite approach, as opposed to small cap, because again, if I explain the trade-off that you're making between the two of those, small cap has more economic sensitivity, and so you don't get as much of that if you go European value, and so hence that's why I would tie break in that way.
Mm-hmm. Very helpful advice. Thank you. So as we start to wrap up our conversation today, Bobby, what can you tell us and leave our listeners with on the path forward for interest rates?
Yeah, so the last time I looked at the futures curves, I think it's pricing in about 5 interest rates from today on into the end of 2026. That having been said, futures curves are notoriously wrong. So I wouldn't prescribe, hey, place this bet based off of the futures interest rate curve. But the things that I am very thinking a lot about and paying very close attention to is the impact of tariffs. Now, and it's twofold. On the one hand, it's still the ones we already have are still very uncertain. I think there's going to be a Supreme Court ruling within the next couple of months that may or may not make the ones we have currently illegal. So that can cause things to move and shake a different way. But even if the ones that we have stay in place, it takes a while for tariffs or taxes, what they are, for it to percolate through the supply chain system. And I don't think we've seen the full effect of all of that yet. And so if that does what I think it does, because conceptually it removes capital from the system, as a result of that, the entire system economy moves slower. And so for that reason, that could provide the impetus for you to get the 5 cuts that are currently priced in from the Fed futures curves. And so those are the things I'm paying the close amount of attention to. And so for that reason, that's why I continue to prescribe an overweight to quality, because those are the companies that are going to be the most able to endure those increases in cost and compression in margins should those tariffs stay in place.
Well, thank you very much for those final thoughts, Bobby. It's been a pleasure speaking with you and really appreciate all the valuable and unique insight you've shared with our listeners today, and enjoy the rest of your time in Toronto while you're here.
Awesome. Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.